Hello to all the passive income investors out there looking for dividend stocks to generate passive income. In this video, I'm going to compare Target and Walmart and answer which one I think is the better dividend stock to buy for passive income investors today. So let's jump right into this analysis.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the first thing I'm going to compare these two on is, of course, the top of mind for dividend stock investors, and that's the dividend yield. Target offers a better dividend yield here, nearly twice, in fact, precisely twice, the rate of Walmart at 2.52% compared to 1.26%. But I usually caution dividend stock investors to look beyond the dividend yield. The dividend yield is not the only metric to consider when evaluating a dividend stock. In fact, I would say it's not even the most important metric to consider when evaluating a dividend stock. Although it is important, I don't think it's the most important. So let's continue. So one thing I want you to understand is the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. Okay, so now that you understand that important concept, look at Target and Walmart according to that metric. You see in the purple the dividend per share for Target well below the earnings per share, going all the way back to 2016, and then in 2015 there was a dip below the purple. But for the better part of the last decade, Target's earnings per share has been above its dividend per share, and comfortably so. The same thing can be said for Walmart. For the better part of the last decade, its earnings per share have been well above its dividend per share. So for both Target and Walmart, they have room to continue paying the dividend and, in fact, increasing the dividend. If I were to give a more specific assessment, Walmart has more room to increase its dividend compared to Target, although they're both doing an excellent job generating profit growth so that they can continue increasing their dividend over the long run. The next thing I wanted to compare these two on is their operating profit margin over a trailing 12-month period. And you could see that Target has had a better operating profit margin than Walmart. And that's partly due to strategy. Walmart tries to sell items at lower prices, but sell more items more frequently. Target goes after a little bit more premium customers, not the discount heavy shoppers that Walmart goes after. Still, they're very similar in that regard, but Target is slightly better in this metric, and slightly better makes a big difference here. 4.68% compared to 4.19% for Walmart. But the next slide will reveal something different. So the next slide, I'm looking at inventory turnover here. And when I look at merchants, brick and mortar merchants, specifically like Target, Walmart, Home Depot, Lowe's, companies like that have strong brick and mortar presence, one of the things I look most closely at is the inventory turnover. How quickly are they able to sell inventory? Because that's the name of the game. How quickly can you get things in that your customers want and then get them into your customers' hands? You don't want things sitting on your shelf, because that's space that could be given to something that's selling more quickly. So in this metric, you can see Walmart leading Target significantly, 11.21 compared to 7.565, and they've had this lead for the previous decade, and I think they'll have that lead for the next decade because of strategy. Walmart sells lower priced, lower margin items, while I mentioned earlier Target is higher margin, higher priced, and they don't go after that high frequency, high turnover. They go after lower frequency, higher margin, and that's resulted in Walmart having the better inventory turnover, with Target having the better operating profit margin. So different strategies from Target and Walmart, and it's evident in the operating profit margin and the inventory turnover. And finally, I wanted to compare these two on their valuation. And judging by the forward price to earnings ratio, Target is less expensive than Walmart. Walmart is trading at a forward PE of 23, whereas Target is trading at a forward PE of 17. Now, before I make my conclusion, one thing I will highlight, and I haven't talked about yet, is the stock split for for Walmart. You're probably wondering how that incorporates into my decision. And I've said this multiple times, stock splits don't have a meaningful impact on a company's performance. They don't change profitability, they don't change cash flow, they don't change competitive position. It just slices up a company's stock into smaller pieces. And so it doesn't play a major role in my decision making. Although I am aware that Walmart recently split its stock, it's not playing a meaningful role in my decision here. So to answer which one I think is the better dividend stock to buy, today I would go with Target. I think the lower valuation combined with the better operating profitability is enough for me to go with Target if I was a dividend stock investor today. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.